Welcome to the Pro Ticker Deep Dive. We're staring down what might actually be the most fascinating and frankly perplexing divergence in modern market history
Oh,
today.
absolutely. It's a completely wild moment.
Right. So we're looking at this fundamental reshaping of the global financial landscape. And we're specifically focusing on the absolute most dominant technology companies on the planet.
The Titans.
Yeah, the Titans, the Magnificent Seven. Our mission today is to unpack a paradox that has just been baffling investors, tech enthusiasts, basically everyone throughout early 2026.
It's a critical moment to analyze for
It
sure.
really is.
Yeah.
We're talking about a very exclusive, incredibly elite group, the $4 trillion club.
Just saying that $4 trillion in market capitalization, it's hard to even wrap your head around.
It is. I mean, it wasn't that long ago, right, that a company hitting $1 trillion was global front page news.
Right. It was a huge milestone. And then suddenly, late 2025, early 2026, we had this VIP section of the market. Valuations over $4 trillion.
Yep. We had Microsoft, Apple, and Alphabet, all just sitting in that club.
But as we sit here today, looking at the data for early 2026.
They've all been kicked out.
Exactly. Evicted.
It's crazy. Microsoft, which surpassed $4 trillion last October, has actually fallen below $3
It was a
trillion.
massive haircut.
Massive.
Yeah.
And Alphabet and Apple, they were both over $4 trillion in early February. Now they're down 11.8% and 9.7% respectively from their highs.
Yeah.
So right now, as we're talking, there is only one company sitting alone at a table for one in the $4 trillion club.
And that is NVIDIA.
NVIDIA, just
Yeah.
NVIDIA all by itself.
Which, perfectly illustrates the structural shift we're going to dissect today.
Yeah, let's get into that because there's a huge disconnect happening here.
There is. We are witnessing this massive gap between absolute corporate performance like revenue generation, market dominance, and relative stock market performance.
Because these companies are pulling in astronomical numbers.
Right. But their valuations are experiencing severe turbulence. The market is basically heavily rewarding the sole provider of the underlying infrastructure, the hardware, the chips.
NVIDIA.
NVIDIA, exactly, while actively penalizing the software companies that are building the applications on top of that infrastructure.
It's like it challenges the basic assumptions investors have held for the last decade.
Totally. NVIDIA essentially manufactures the absolute prerequisite technology for the artificial intelligence era. Meanwhile, the companies buying that technology are just facing intense, brutal scrutiny.
And that scrutiny is hitting the entire Magnificent Seven hard.
Oh, yeah.
For you listening, if you watch these dominant large-cap tech companies closely, the start of 2026 has been a huge wake-up call.
A total reality check.
Microsoft, Apple, Amazon, Alphabet, Meta, NVIDIA, Tesla. They power the entire stock market's growth for years, but this year has brought a massive reshuffling.
And what's incredibly telling there, well, it's that Microsoft and Amazon are currently the two worst performing stocks within that Magnificent Seven group in 2026.
Which feels backwards. Microsoft and Amazon are the cloud kings.
Right, but that specific detail, Microsoft and Amazon lagging behind the rest, that is the Rosetta Stone for understanding this entire market dynamic.
Okay, unpack that. Why those two specifically?
Because they are the ultimate hyperscalers. They are the ones bearing the absolute brunt of this technological transition.
The transition to AI.
Yes. Think about it. For the last 10, 15 years, big tech hyperscalers operated on a very specific, very lucrative business model.
Capital light.
Exactly. Capital light, high margin businesses. You write a piece of software or you build a digital platform, and the cost to distribute it to the next million users is
Basically zero.
virtually zero. The profit margins were unlike anything we had seen in the history of capitalism.
You build it once and you sell it infinitely. It was a digital printing press.
It was. But in just a couple of years, the artificial intelligence revolution has violently inverted that paradigm.
Violently inverted. I like that phrasing.
It's true, though. These companies are no longer just capital-light software platforms. They have been forced to become capital-intensive, heavy industries.
Heavy industry. Like building factories.
Exactly like building factories. They are pouring unimaginable amounts of money into physical infrastructure, data centers, raw compute power, real estate, power grids.
And as the stock performance of Microsoft and Amazon shows, investors are not happy about this sudden metamorphosis.
Not at all. Wall Street hates uncertainty, and they really hate capital expenditures replacing pure profit.
Okay, I want to really dig into this idea of the capital light versus capital intensive model, because it is the foundational thesis of why a company like Microsoft is suddenly bleeding $1 trillion in market cap.
It's the whole ball game right now.
Let's look at Microsoft's specific situation, because it's the ultimate paradox. They recently reported their earnings, and they didn't just meet expectations.
They crushed them.
They posted absolute record results. Their cloud business alone is booming. It raked in over $50 billion in revenue in just its latest quarter.
$50 billion in 3 months.
Right. You hear that number, and you logically assume the stock is going to skyrocket.
Any normal quarter in the last decade, it would have.
But instead, Microsoft fell after reporting those record earnings. The stock is down 22% from its record high.
Yeah.
How does a company report $50 billion in quarterly cloud revenue and get completely punished by Wall Street?
It comes down to 2 words. Capital expenditures.
CapEx.
CapEx. What investors are looking at is not the revenue coming in today, but the massive, staggering amounts of money flowing out the door to build the infrastructure for tomorrow.
They're looking at the credit card bill, basically.
Right. The critical issue is that Microsoft's capital expenditures are growing far faster than their revenue and their earnings.
So it's a fear of the unproven.
It is a fear of the return on invested capital, ROIC. Wall Street is a mechanism that values predictability and defined paths to profit.
And building AI factories is not predictable yet.
Not at all. When you transition from a software model to a capital-intensive model, you are fundamentally changing the financial DNA of the company. Investors are looking at these earnings reports, and they are deeply concerned about the path to profitability of Microsoft's AI investments.
Let's use an analogy here to make this tangible for everyone listening. Because when we just say capital expenditures, it can sound like standard, boring corporate accounting.
Right, it sanitizes what's actually happening.
Exactly. So imagine you run a highly successful digital bakery.
Okay, I'm with you.
For years, your only real cost was paying a few brilliant recipe writers. You typed up a recipe, put it on your website, and millions of people bought it for $5 a pop.
Your profit margins are what, 90%?
At least 90%. Everyone loves your stock. You're the darling of Wall Street. But suddenly, to stay relevant in a new era of baking, you announce you can't just sell recipes anymore.
The market shifted.
The market shifted. You have to physically bake the bread yourself. And to do that, you are buying up hundreds of thousands of acres of wheat fields. You're buying massive industrial farming equipment.
Tractors, combines.
Yep, you're constructing enormous, power-hungry milling plants all over the world.
That is an incredibly accurate way to frame what hyperscalers are doing right now.
And as an investor in that bakery, I'm looking at that and saying, wait a minute. You are spending billions on tractors and factories. Your profit margins are going to plummet.
When do I actually see the return on all this heavy machinery?
Right. I might even acknowledge that you need to do this to survive, but I'm still going to sell your stock today because the golden era of your 90% profit margins is over.
And that is the exact calculation happening with Microsoft right now. The market is looking at the sheer volume of data centers being built, the massive orders for NVIDIA chips.
At $30,000, $40,000 a chip.
Exactly. The energy costs required to just keep them cool. And they are asking, can the software revenue generated from AI actually cover the depreciation and the ongoing costs of this physical infrastructure?
And right now, the market's answer is, we're not sure.
When capital expenditures outpace revenue growth, it creates a gravitational drag on the stock price, no matter how good the top-line revenue number is.
But wait, if Microsoft's stock is dropping 22% because they're spending too much, and investors are demanding a clear path to profitability, why don't they just slow down?
They can't.
Why not just tap the brakes on the CapEx and let the revenue catch up? Wouldn't that instantly make Wall Street happy and push them back into the $4 trillion club?
They cannot slow down because they view this as an existential transition. The consensus is that Microsoft's AI bets are bold but calculated.
Calculated how?
Microsoft understands something fundamental. Traditional software is under threat. If they tap the brakes to appease short-term investors, they risk losing the entire future of computing.
Software is under threat. That is a massive statement coming from the company that essentially built the modern software industry.
It's the ultimate innovator's dilemma.
Let's spend some time on this because it completely redefines their strategy. What does it mean that software, the thing Microsoft has monetized better than anyone in history, is suddenly under threat.
To understand the threat, we have to look at how humans have interacted with computers for the last 40 years.
Okay.
It has always been a paradigm of manual instruction. You open an application, a word processor, a spreadsheet, a web browser.
You click the icon.
Right. And you, the human, are the orchestrator. You click the buttons, you type the formulas, you navigate the menus. The software is just a passive tool waiting for your command.
I tell it what to do, and it does it.
But Microsoft recognizes that this entire platform is being rewritten. We are moving from passive applications to active agents.
Agents.
Yes, a new app platform is being born. You can basically think of agents as the new apps.
Agents are the new apps.
Yeah.
This is where the philosophy of tech really meets the reality of the stock market.
Absolutely.
Walk me through a world where an app doesn't exist. Because I am looking at my phone right now, and it is just a grid of dozens of apps.
We all are.
I use an app to check my email,
Mhm.
an app to order food, an app to hail a ride. How does an agent replace an app?
Think about the friction involved in your current process. Let's say you want to book a business trip.
Okay.
You open a travel app to find the flight. You open a hotel app to find a room. You open your calendar app to check your dates.
And I'm cross-referencing all of them.
You open your corporate expense app to check your budget. You are manually porting data and context across 4 different software silos.
It takes 20 minutes and a lot of copy and pasting.
Exactly. In an agentic paradigm, you don't open any of those apps. You interact with a single AI agent and you just give it a high-level intent.
Like just telling it what I want.
You say, book my trip to the conference in Chicago next week, keep it under my usual budget, and make sure I arrive before the opening keynote.
And the agent just goes out and does the manual labor.
The agent natively understands your calendar. It knows your corporate expense policy. It can autonomously interface with the airline and the hotel APIs to execute the transaction.
Behind the scenes.
Entirely behind the scenes. The traditional app, that graphical user interface with all its buttons and menus, becomes completely invisible to you. The agent negotiates directly with the underlying services.
So if I'm a developer who builds traditional apps, I should be terrified. Because Microsoft is saying the user interface I spent all my time designing is about to be bypassed entirely.
Bypassed and commoditized, yes.
And if you are a company whose entire business model relies on controlling an ecosystem of those traditional apps,
Now we're getting to the core of the market shift.
say a company that runs a massive mobile app store and takes a 30% cut of every transaction.
You should be deeply concerned.
And there is the connection to Apple. Apple was also in the $4 trillion club, and they are also down nearly 10% from their highs.
Everything is connected.
If agents are the new apps, that doesn't just threaten Microsoft's traditional software. It threatens Apple's entire walled garden. If I don't need to download an app to achieve a task, I don't need the App Store.
Precisely. The shift from apps to agents is a structural threat to the mobile duopoly of the last decade.
Wow.
And we can apply this exact same logic to Alphabet, which is also down almost 12%.
Right, Google search.
Yes. If an AI agent can proactively fetch information, summarize it, and execute a task for me, my need to manually type queries into a traditional search engine diminishes significantly,
And if I'm not typing in queries, I'm not scrolling through pages of sponsored links.
which is Alphabet's primary revenue engine.
So this is why the Magnificent Seven are seeing such a violent reshuffling.
Right.
The very foundation of what made Apple, Alphabet, and Microsoft multi-trillion-dollar entities is under attack.
Existential attack.
The App Store, Google Search, and traditional Windows and Office software, all threatened by the very AI technology they are rushing to adopt.
It is the ultimate innovator's dilemma playing out on a multi-trillion-dollar stage. They have to disrupt themselves before someone else does.
Which brings us right back to Microsoft's massive CapEx spending. Why are they willing to tank their own stock price in the short term to build this infrastructure?
Because they're trying to build the foundational platform for this new agentic era.
They don't want to just be a participant.
No, they aren't just trying to build one smart chatbot. They are trying to be the underlying utility grid where every company in the world builds and hosts their own agents.
They want to be the operating system for the AI economy, just like Windows was for the PC economy.
Exactly. History repeating itself, but at a much higher cost of entry.
And this requires a very specific technical approach. Something fascinating about Microsoft's strategy is that they aren't just locking everyone into one proprietary model.
Right, that's a huge point. Microsoft actually has the broadest selection of models of any hyperscaler.
Why does having the broadest selection matter? Why don't they just build the single best Microsoft-branded AI model and force everyone to use that.
That's the old playbook.
Yeah, that's the traditional tech monopoly playbook. Lock everyone into your tech.
It is, but it's too risky in the current AI landscape. The speed of innovation in generative AI right now is unprecedented.
Models get leapfrogged every few months.
Exactly. So if Microsoft bet their entire $150 billion infrastructure solely on one internal model, and a competitor released a significantly better model 6 months later,
They're stuck.
Microsoft's massive data centers would suddenly be hosting obsolete technology.
Billions of dollars down the drain.
So by offering the broadest selection of models, allowing customers to run OpenAI's models or open source models or specialized models from other startups, Microsoft shifts its position.
From competitor to host.
They go from being a competitor in the model race to being the neutral arms dealer.
They become the marketplace.
Yeah.
It's like a supermarket.
That's a great way to put it.
They don't care if you buy the name brand cereal or the store brand cereal as long as you're buying it in their store.
Exactly. If a developer discovers that a specific, tiny open source model is perfect for analyzing legal documents, and a different massive frontier model is better for writing code, Microsoft's cloud allows them to use both seamlessly.
And they capture the compute revenue either way. You're renting their servers no matter what software you run.
This neutrality is a massive moat. It ensures that regardless of which AI research lab wins the intellectual race to build the smartest model, Microsoft still wins the economic race by providing the compute power to run it.
Okay, so we've established why they are spending the money. They're building a new platform for agents because apps and traditional software are dying, and they are hosting everyone's models to hedge their bets.
Yes.
But we have to return to the investors' panic. The stock is down 22%. Is Wall Street overreacting? Because earlier you mentioned that analysts think Microsoft's AI bets are calculated. And we know the company can actually afford to ramp up this AI spending without compromising its financial health.
This is where the long-term investors completely diverge from the short-term traders.
Okay, break that down.
The fear of margin compression is real, the CapEx sledgehammer is real, but Microsoft's underlying financial engine is uniquely robust.
Right, the $50 billion cloud quarter?
Exactly. The cash flow generated by their legacy, high-margin software businesses, Office, Windows, traditional Azure hosting, is staggering.
It's a money printing machine.
They are essentially using the massive profits from the current computing paradigm to subsidize the construction of the next one.
They're self-funding their own disruption.
Exactly. Unlike a startup that has to beg venture capitalists for money to build an AI data center, Microsoft generates the necessary capital organically every single month.
That's an incredible luxury.
They can absorb a level of capital intensity that would bankrupt almost any other company on Earth.
Which leads to a very strong conclusion from market watchers.
Which is?
That despite the 22% drop, the sell-off in Microsoft is an impeccable buying opportunity for long-term investors.
Impeccable. That's the word being used.
It's a strong phrase. It implies that the market is currently mispricing the stock because it's overly focused on the short-term cost of the tractors, to go back to our bakery analogy.
Right. They see the tractors and panic.
And they're completely ignoring the future value of owning all the wheat fields in the world.
The argument is that once the heavy lifting of the infrastructure build-out is complete, or at least reaches a steady state, the sheer volume of enterprise AI workloads running through Microsoft's data centers will yield unprecedented cash flows.
The current pain is just the entry ticket.
The entry ticket to the next decade of dominance.
But there is a massive assumption baked into that impeccable buying opportunity thesis.
There's always an assumption.
It assumes that the customers, the big enterprises, the Fortune 500 companies, are actually going to adopt these AI agents en masse. If Microsoft builds a $150 billion planet-scale AI factory, and the corporate world decides that AI agents are just a fad, or they're too risky, or they hallucinate too much,
then it's a disaster.
Microsoft is left holding the bag on the most expensive infrastructure project in history.
That is the ultimate risk. The path to profitability absolutely requires enterprise adoption.
Has to happen.
But generally, the outlook remains optimistic about the long-term prospects.
Because of the productivity gains.
Because the productivity gains promised by agentic AI are simply too massive for global enterprises to ignore. If an AI agent can reduce customer service costs by 40% or accelerate software development by 30%, competitive pressure will force adoption.
If your competitor uses agents and you don't, you go out of business.
Basically, yes.
Okay, so if we take the optimistic view that Microsoft's CapEx bet pays off, The agents replace the apps and they eventually return to the $4 trillion club. We have to look at the one company that is currently sitting in that club right now.
The one cashing all those checks.
The company that is happily cashing Microsoft's massive CapEx checks. NVIDIA.
Yes. NVIDIA's position in this dynamic is completely unique.
As we established, Microsoft, Alphabet, and Apple got kicked out of the $4 trillion club, leaving NVIDIA with a table for one.
Which is just an unbelievable sentence to say out loud if you've followed tech for the last 20 years.
Right. The chipmaker is more valuable than the software giants.
It's a total inversion of the hierarchy.
But there's a massive, glaring vulnerability for NVIDIA here. Their growth rate could decline if hyperscalers slow their spending.
Absolutely.
Or worse, if key customer CapEx growth turns negative, NVIDIA could face a cyclical downturn.
This is the inherent fragility of NVIDIA's current valuation. NVIDIA stands to benefit massively from increased hyperscaler capital expenditures. Their order book depends heavily on data center spending.
But what does that actually mean in practice for their revenue?
It means NVIDIA's revenue is not highly diversified, not across millions of everyday consumers the way Apple's is, or millions of small businesses the way Alphabet's is.
They aren't selling GPUs directly to you and me.
Right. A staggering percentage of NVIDIA's revenue comes from a very small handful of massive customers.
The hyperscalers.
Yeah.
Microsoft, Meta, Amazon, Alphabet.
Exactly. NVIDIA is currently the arms dealer in an arms race, but an arms dealer only makes money as long as the superpowers are terrified of falling behind.
Oh man, that's a great point. If the superpowers declare a truce,
Or, in this case, if Microsoft and Amazon look at their plummeting stock prices and say, okay, Wall Street is punishing us too much, we need to cut our CapEx by 20% next year to protect our profit margins.
then what happens to NVIDIA?
NVIDIA's revenue doesn't just slow down, it could hit a brick wall.
If key customer CapEx turns negative, NVIDIA faces a cyclical downturn. That is a terrifying prospect for a company valued at $4 trillion.
It means NVIDIA is entirely dependent on the psychological fortitude of Microsoft and Alphabet CEOs.
And their willingness to endure short-term stock market pain.
If Satya Nadella at Microsoft or Sundar Pichai at Alphabet decide they can no longer absorb the CapEx sledgehammer, NVIDIA's order book evaporates.
But let me push back on that vulnerability for a second, because there is a completely contrasting viewpoint out there.
Oh, there definitely is.
While the cyclical risk is real, there is a massive prediction out there regarding NVIDIA's trajectory. That NVIDIA will actually overtake Alphabet, Apple, and Microsoft to become the world's most profitable company by the end of 2027.
That is an incredibly bold forecast.
Right. To become the world's absolute most profitable company by net income, that means they aren't just selling a lot of chips.
It means they are maintaining astronomical profit margins on those chips, and the volume of sales is compounding year over year.
So if I'm an investor trying to reconcile these two things, the risk of a cyclical downturn versus the prediction of becoming the most profitable company on Earth, how do I make sense of it?
It's a tough needle to thread.
Because if Microsoft and Amazon are the worst performing Mag 7 stocks right now because they are spending too much money on NVIDIA chips, doesn't that make NVIDIA's $4 trillion valuation a massive house of cards?
If the software guys flinch, NVIDIA goes to zero. That's the fear.
Exactly.
But it is not necessarily a house of cards. It's more of a tightly coupled ecosystem. The prediction that NVIDIA will become the most profitable company by 2027 rests on the assumption that the hyperscalers cannot flinch.
The arms race dynamic is too strong.
Exactly. If Microsoft stops buying NVIDIA chips to protect its margins, Alphabet will just keep buying them to catch up in AI.
And suddenly Microsoft's cloud becomes technologically inferior.
Right. None of these trillion-dollar hyperscalers can afford to blink.
It is a game of high-stakes corporate chicken. They are all locked in a room, forced to keep passing billions of dollars to NVIDIA because the first one to stop spending loses the AI war entirely.
Precisely. And NVIDIA is the one collecting the toll.
And they have massive pricing power.
Unprecedented pricing power. They aren't just selling silicon. They're selling the software ecosystem that developers use to write AI models. It creates a massive lock-in effect.
Even as Microsoft and Amazon try to build their own custom chips to compete.
The demand for NVIDIA's cutting-edge GPUs remains insatiable because they are the gold standard for training the most advanced frontier models.
So if the hyperscalers are forced to keep spending and NVIDIA keeps collecting the tolls, the prediction holds true. NVIDIA scales to profitability heights we've never seen.
And entirely funded by the capital-intensive pivot of the traditional software giants.
But we must acknowledge the broader industry dynamics this creates. The performance of all these giants, Microsoft, Alphabet, Apple, and NVIDIA, is just being scrutinized so intensely.
Because investors are trying to assess the broader impact of these AI investments on profitability and the potential for a larger market correction.
Market correction. That is the dark cloud hanging over this entire transition.
It is.
If the Magnificent Seven stocks have faced these severe headwinds in early 2026, leading to a reshuffling of market capitalizations, it raises serious questions about the sustainability of the entire AI-driven rally.
The market is fundamentally a weighing machine in the long term, but a voting machine in the short term.
And right now, the votes are all over the place, highly volatile.
Investors are ecstatic about the promise of agents as the new apps, but they are deeply anxious about the $150 billion price tag to build the infrastructure.
They are thrilled by Microsoft's $50 billion cloud quarter, but terrified that CapEx is growing faster than earnings.
It is a market suffering from severe cognitive dissonance.
We want the revolutionary AI future, but we want it delivered with the 90% profit margins of the 2010s software era.
And the reality is that you simply can't have both. The transition from capital light to capital intensive is a permanent structural change to how the tech industry operates.
Permanent.
Yes. And analysts remain generally optimistic about the long-term prospects, particularly for those well-positioned in the AI space.
Because they believe the productivity gains on the other side will justify the cost.
Exactly. But the journey from here to there will be incredibly turbulent. The $4 trillion club might remain a table for one for quite some time.
Or we might see rapid evictions and new admissions as the market slowly digests the reality of this new economic paradigm.
It's going to be a bumpy ride.
So, as we try to synthesize everything we've discussed today, the fall of Microsoft, Apple, and Alphabet from the $4 trillion club, the rise of the capital-intensive hyperscaler, the death of traditional apps in favor of autonomous agents, and NVIDIA's precarious position as the sole toll collector, what is the defining takeaway for you listening right now?
How should they interpret this volatility?
Exactly. How do we make sense of 2026?
The defining takeaway is that we are living through a period of necessary friction. The stock market is violently repricing these companies because the fundamental nature of what it means to be a tech company has changed.
We are no longer in the era of cheap software scaling.
We are in the era of heavy industry digital utilities. Microsoft and Amazon are being punished today not because their businesses are failing, but because they are undertaking the most expensive infrastructure build-out in human history to secure their dominance for the next 20 years.
If you believe that AI agents will fundamentally reorganize human labor and software interaction, then the current volatility is simply the price of admission to that future.
It is the messy, expensive middle phase of a revolution. You have to buy the wheat fields before you can sell the new kind of bread.
Precisely. And while the short-term margin compression is painful for investors, the companies that refuse to swing the CapEx sledgehammer today will likely find themselves completely irrelevant by the end of the decade.
Replaced by those who did.
Here's a provocative thought to leave you with, something to mull over on your own as you watch these stock prices bounce around over the next few months. We spent a lot of time today talking about Microsoft's vision of agents as the new apps. The idea that you will have an AI agent booking your flights, managing your calendar, executing tasks for you.
The human-to-agent interaction.
Right, but think about the implications of that at scale.
Yeah.
What happens when it's not just humans interacting with AI agents, but millions of AI agents autonomously interacting with each other?
Oh, wow.
Imagine a world where your company's AI supply chain agent starts instantly negotiating with a logistics company's AI trucking agent. They are requesting quotes, comparing prices, analyzing weather patterns, and executing binding digital contracts in milliseconds, completely without human intervention.
The speed of that economy would be unimaginable.
Now multiply that by billions of daily microtransactions across the global economy. The sheer amount of compute power, data center capacity, and electrical energy required for a true machine-to-machine economy will make today's massive capital expenditures look incredibly small.
A drop in the bucket.
If Microsoft and NVIDIA are right about the trajectory of this technology, the current $150 billion infrastructure build-out isn't the end of the capital-intensive era. It is barely the beginning.
A truly profound concept to consider. The infrastructure demands of an agent-to-agent economy would redefine the scale of the technology sector entirely.
We're going to need a lot more wheat fields. Thank you for joining us on this exploration of the changing tech landscape. Keep an eye on those CapEx numbers, and we will catch you next time on The Deep Dive.